Good afternoon, everyone. Good afternoon, everyone. Who had a pretzel? Who had a pretzel? Who went out there and had a pretzel? Okay, all right. So what is the Oreo thing? Is that an ice cream?
Ice cream.
Oh, who had an Oreo ice cream? Okay, all right. Who had something to drink? Okay, all right, okay. So, just want to make sure everybody's ready. Now, you already had a break. You had enough to keep you awake. No. We're going to shake, rattle, and roll. We're going to get out of here ahead of time because I'm standing between this meeting, the nominating committee meeting, but I'm standing between us having something for the CEO and honoring the CEO today. And I'm going to tell you a little secret. Mr. Tom has something to drink for everybody.
Oh, good.
So I think we got everybody in that we need in. This meeting is now called to order. No roll call needed. I will mark everyone, present. I thought you got that pretzel for the lady. Oh. Rep Brenda, he offered you a pretzel.
Oh, thank you.
Good afternoon, everyone. I'm a South Carolinian, and my name is Representative Carl Anderson, and I will be chairing this meeting today. I need someone to make a motion for us to waive the quorum requirement. All right, second. Properly moved in second that we waive the quorum requirement. All in favor signify by saying aye.
Aye.
Those who oppose will vote nay. The ayes have it, and so it's ordered. And I'm also going to ask that we approve the July 19th, 2024 meeting minutes.
Second.
Got a motion and a second. Ready to vote? All in favor say aye.
Aye.
Those who oppose will vote nay. The ayes have it, and so it's ordered. We'll start today with a presentation on wellness, the wellness program, innovations, and the long-term care insurance market. With us today is Mr. Michael of Assured Allies. We'll hold questions until he is finished. Mr. Michael, thanks for being here, and please go ahead.
Thank you, Mr. Chairman. Can you hear me okay?
We can't hear you.
Oh, no. Can you hear me now?
There you go.
All right. I'll bring it closer. So thank you, Mr. Chairman. My name is Mike Gugig. I am the U.S. General Counsel for a company called Assured Allies. And as we go through the presentation, you'll learn a little bit more about what we do and how we do it. Some points I'd like to go over today. I have my presentation backwards in front of me. We have been able to develop a proven solution to help seniors age successfully and delay the onset of disability or chronic illness in the way that it's discussed in long-term care parlance for a period of time to allow policyholders to stay at home independently for longer than they otherwise would have. Second, NCOIL and the NAIC have both passed model laws removing from the definition of rebating the types of wellness programs we're going to discuss today. Only about 30 states have adopted one or the other of those models, so I'm here today in part to advocate for passage in other states. We've got two parts of our program. One is called Age Assured, and Age Assured, we help in-force policyholders of long-term care insurers with a wellness program And the goal, again, is to allow them to live independently without help for as long as possible. The other half of our business is called Never Stop. At Never Stop, we currently work with one insurer. We are trying to create new, innovative long-term care policies so that that market can become more robust. As you may know, back in the early 2000s, there were about 150 or 175 long-term care insurers. That number is now down to essentially a handful. And we're trying to do something about that by generating new products. And finally, you'll hear this theme throughout. Wellness programs create a win-win for both policyholders and their insurers, and we believe should not be considered an illegal rebate. So why is this important? The need is manifest. Americans are getting older. Seniors are the fastest growing population. Roughly 10,000 baby boomers a day are turning 65. And that's going to last for at least another 20 years. So we have a significant long-term care problem out there. At the end of the day, when folks have to go on Medicaid, that implicates your budgets. And what we are trying to do is help broaden the market for long-term care insurance and keep people out of the need to become impoverished and go on Medicaid. Getting older is hard. There is a 9-year gap between what we call lifespan and health span. Lifespan is what we all know as lifespan. Health span is how long you can live without disability. And there's a 9-year gap in those two numbers. 70% of seniors who turn 65 at some point in their lives will need long-term care services, and 80% of seniors have no way to cover that outlay of money, which is quite expensive. Long-term care, aside from a couple of unique situations, is not covered by Medicare. As I mentioned before, Medicaid is the payer of last resort. Aging takes different roads for different people. As you'll see on the chart on the right, I know it's hard to see, there are factors that go into making people become disabled and ready to go on claim on their long-term care insurance policies. Loneliness is certainly one of them. Falls in mobility, cognitive decline, hearing loss. By the way, hearing loss, for those of you who are unaware, there is a sharp connection between hearing loss and cognitive impairment. And so one of the things that we do as part of our wellness program is to encourage policyholders and members of our program to get their hearing aids. My father used to say, I don't want a hearing aid. I don't want anybody to know that I can't hear anything because I'll have a little thing in my ear. Meanwhile, he was walking around with an oxygen tank. That's my dad. Again, the goal of our wellness program is to help policyholders remain at home, independent, for as long as possible. Assured Allies is changing the way that aging can occur through the use of predictive analytics. How does that happen? We find the right intervention for the right person at the right time. Again, the goal is to help members stay in their homes independently for as long as possible. And by intervention, I don't necessarily mean expensive things. There are inexpensive things that can make people's lives so much easier and so much more independent. Things like, I call it a pickup stick, things like the extended arm to pick up things off the floor. There are unique gadgets to help people put on their socks and put on their clothing if they have trouble doing that. These are inexpensive interventions, but that can go a long way. And our goal, and again, it's tough to see the dotted line there, but our goal in our program is to try and move the dotted line as close to the solid line as we possibly can. And here's where the rubber meets the road. In a 2-year randomized controlled study, we were able to demonstrate a this was with one insurer on their block of business. We were able to demonstrate a 10% reduction in claim costs over the course of 2 years, and an 8% reduction in incidents over the course of that 2 years. For those of you who are familiar with the problems of long-term care carriers, a 10% reduction, or to be frank, even a 4 or 5% reduction if our results are not indicative for others, will cause a massive positive effect on long-term care carriers. At the end of the day, the goal would be that if we can reduce claim costs by a significant amount, and we believe we can, the hope is that as time goes by over the long term, the need for rate increases or the amount of rate increases that are needed will go down by virtue of programs like ours and others that we hope will join the market soon. No other insurtech company has been able to scientifically validate this type of statistically significant claim savings on standalone long-term care insurance policies. Again, this type of performance can shift the claims curve and may reduce the need or the size of future rate increases. And I'm taking you at your word, Mr. Chairman. I'm flying through these things.
Go ahead.
All right.
Tell the joke again about your daddy.
Well, I will say this. My father, for the Life Insurance Committee, my father gave me the best definition of life insurance when I was a kid that I have ever heard to this day. And I have been representing life insurers now for coming up on 30 years. And that is, the insurer is betting you're going to live and you're betting you're going to die. And that's really the equation in life insurance. That's another witticism from Fred Gugick. We are in a situation in connection with the wellness program where it is one of the only times that I can think of that insurers and their insureds have completely aligned interests. That generally doesn't happen in the business of insurance, but here it does. Policyholders use our wellness program, age at home for longer than they otherwise would have, and that is absolutely a win. There is lots of research out there. Seniors would like very much to remain at home and independent for as long as they possibly can. They generally don't want people coming into their homes to help, and they even more forcefully don't want to go into facilities, particularly nursing homes. By the same token, as we're helping insureds, we're helping insurers. We're doing the right thing for policyholders. Carriers are providing this service for free. There is no out-of-pocket expense to the policyholders. All the expenses are borne by the insurance carriers. So they're doing the right thing by their policyholders, and at the same time, they're reducing their claim costs. This is a definitive win-win for policyholders and for insurers alike. We have some evidence of how our members like the program. Again, the services are free. 30% of those eligible to join our program actually complete onboarding and go through at least part of the wellness program. And we have an NPS score, a Net Promoter Score of 50 plus so far. A score of 50 is considered excellent in the NPS world. And basically what NPS chooses to measure is whether, and you've all answered this question on online surveys, whether you would recommend the product or service to your friends and family. And that's what NPS measures, and it's a resounding yes from our policyholders. The other side of our business is called Never Stop. And what Never Stop does is it pairs long-term care insurance and wellness programs and embeds the wellness program into the long-term care policy. It's actually, in this case, it's an annuity. It's a hybrid annuity. It's a fixed indexed annuity that has with it a tax-qualified long-term care rider, so there's a full panoply of long-term care benefits, and also a rider that specifically allows for a wellness program. And the reason that that's so important is because in order to avoid rebating statutes in those states that basically still consider wellness programs to be a rebate, the policyholder, it wouldn't be a rebate because it's embedded in the policy. The rule for rebating is if something is something of value that you're giving a policyholder that is outside the four corners of the contract, that is a rebate. And so this takes away the need for any kind of rebating concern. The interesting part about this particular annuity is that policyholders can gain LTC coverage by engaging in healthy actions while they own the annuity. And people who are buying these annuities are generally in their 50s and 60s. They're probably 20 or 30 years away from going on claim. The best time to encourage people to engage in healthy actions is when they're younger, so they don't find themselves in the bad situation when they're older and they actually need care. The incentive for taking healthy actions drives more policyholders to participate in the program, and they can earn up to an additional 15% of their base long-term care amount by engaging in these healthy activities. So for example, if somebody has $200,000 worth of coverage, if they engage in healthy activities for a period of time, they can get $230,000 worth of coverage. And we have found that that incentive really does drive participation in the program. And here, this is my last slide, Mr. Chairman. Again, I'll mention NCOIL and NAIC have each passed model laws that would remove wellness programs and other value-added services from the definition of an illegal rebate. NCOIL's model is called the Rebate Reform Model Act. The NAIC recently updated their Model Unfair Trade Practices Act to put in similar language to what NCOIL has. We are agnostic as to which path states choose to go or whether they choose to do it by bulletin out of the regulator's office. But we do believe that the 20 or so states that have, where it's ambiguous as to whether or not a wellness program is permitted, really should make it explicit so that we don't run around having ambiguities in our way and trying to figure out who's going to allow it and who's not going to allow it. With that, Mr. Chairman, I will stop. Happy to answer any questions anybody has.
Mr. Michael Guge. Did I say that right?
Excellent job.
Man, look at that.
You get the prize.
Yes, man. I'm growing up. I grew up in a little country town called Georgetown, and they think I can't pronounce names like that. You're all right, man. See, Mr. Tom, I got it, man.
Very impressive.
On your way out, I'm getting it. Hey, Mr. Tom, would you stand up?
I am standing.
This is our CEO, who we are honoring at 6 p.m. today, Mr. Tom, who has done an excellent job with NCOIL. That's another joke, you know. He said he was standing up, right? Okay. All right, legislators, do we have any questions? Go ahead, Representative Stevens. Please give him a mic.
Am I?
Oh, there you are.
Whoa. Sorry about that. So the question, it's a twofold question, I guess. The question is, the legislation that we're looking at is to reform existing contracts to allow for these types of rebates or enhancements for good performance. And you don't need that for new contracts, or you're looking for clarity on new contracts as well? I'm trying to understand what the
Yeah,
ask is.
it's a very good question. We are asking for both, actually. People who have policies now, one of the problems with the anti-rebating laws is that they have this word, sale, procurement, administration of policies. And some people construe the offering of a wellness program as offering something in the administration of the policy that is somehow improper as a rebate. So we're actually, it's not the policies that we're looking to reform, it's the statutes that actually need to be reformed in order to expressly permit wellness programs and other value-added services to be considered a non-rebate.
Mr. Chairman, if I might, one more.
Go ahead.
So most of the issues I hear related to long-term care product is the rich products that were written 5, 10, 15, maybe 20 years ago, and the rise in costs. So the people in the nexus that I see as being conflicted are basically somewhere between 70 and 80, and they're finding an increase in cost and the inability to sustain it and figuring out whether they have to compromise on the benefit package or look for reduction there. You describe this as the perfect product for 60 to 65 or 70-year-olds. So I'm dealing with the constituent base that's going to be between 70 and 80. Do we think that and with existing contracts, do we think it would apply to them, and what kind of either enhancement to their benefit or reduction in claims would it lead to?
Well, hopefully it actually does the opposite. Yes, we want very much to be able to offer wellness programs to in-force policyholders, those policyholders that currently have their products. The policyholders that get the most bang for the buck from our wellness program are over 80. And they're sort of in a time where they're deteriorating, and the goal is to try to stop them from deteriorating as much as we can. So it is definitely in-force business that we want to be able to offer wellness programs to without violating the law, obviously.
Sorry, but I guess between the insurance and the insured, the estimate is that the full amount of claims that they're going to make, if we can extend the time that they're living independently, is lower. So there's a mutual benefit in the program because you're not paying 100% for long-term care in a nursing home for 5 or 10 years, and the time in the nursing home is more restricted because they've extended their independent lifestyle.
You got it exactly right.
Thank you, no further.
I want to thank the senator from Connecticut for asking his series of questions.
Representative, sorry.
We will now hear from the senator of Michigan, Senator Roger. I don't know why y'all representatives are holding the mics from the senator.
It's because we talk loud enough, we don't need them.
Amen to that.
One is, how do you monitor the person to make sure they're meeting the criteria to get the bonus or the extra? And number two, do you see anything on the horizon that we might have to look at to say this is what we consider the proper way to monitor somebody before that gets kind of sideways? I don't know if you've seen anything like that yet or not.
Yeah, I haven't seen that part, but how we monitor is actually exclusively with a human touch. We have people who we call allies who get on the phone or get on Zoom calls with our members and go through what they have done or what they haven't done. Part of it is trust. You know, if they tell us they've walked 20 minutes a day, 3 times a week, we believe them and we give them credit for that. I don't think there would be benefit in legislating sort of what goes in on the ground level of a wellness program. I just think there are so many disparate kinds of ways to approach it. We've chosen one way and we think it's successful, but there will be other ways as well. And so sort of legislating what a wellness program would look like, as much as I would love to say make mine the law, I don't think that's a good policy solution. Sure.
Any other questions?
Thank you, Mr. Chairman.
Thank you, everyone, and thank you again, Mr. Michael. We really appreciate you being here today, and you have really lifted us up, and you have helped us to understand some things. And now, you said baby boomers, right? And how old did you say the baby boomers are now?
Baby boomers were from 1946 to 1964, so I will tell you I am at the end of the baby boomer generation, so I am talking about myself.
Well, you're talking about me too, because I'm right there with you towards the end of that baby boomers. But when the question was asked about the wellness and all of that, I started walking 2 miles a day, and then I went up to 3 miles a day, and and then I tried to get 10,000 steps in. I don't know what happened. I fell off the wagon for the past month, and yesterday was the first day that I got over 10,000 steps. And because of that gentleman that's sitting behind Mr. Patrick named Mr. Gary, he made me walk last night to the Alamo and walk back. So I ended up getting my 10,000 steps in. So thank you, Mr. Gary.
We'll put them on the payroll.
I'm the one need to be paid. Next on our agenda is a presentation on the 2024 Life Insurance Mortality Risk Management Study from LexisNexis Risk Solutions. Joining us today is Mr. Patrick of LexisNexis Risk Solutions. We'll hold the questions until he finishes. Mr. Patrick, thanks for being here, and please go ahead.
All right, thank you very much, Mr. Chairman. As he mentioned, I am Patrick Sugent. I'm a VP of Data Science at LexisNexis Risk Solutions. And today I was going to talk about how our white paper we recently released that shows how you can combine medical data and non-medical data to help prove the life insurance underwriting process so it benefits consumers by making the process faster, easier, and more accurate. Before I get into the study, though, and I certainly hear the comments about time, so I'm going to try to breeze through this fairly quickly. But before I get into the study, I wanted to just give a brief, very brief introduction to myself and my company for those that don't know. LexisNexis Risk Solutions is a data and analytics provider to insurance carriers and among other entities, among other industries. And I personally work in the life insurance part of the LexisNexis insurance category. LexisNexis is very committed to strong governance principles when it comes to the proper use of AI, as well as putting the consumer first in our products and in our solutions. I personally, as a result of that, even though I am a geeky data scientist introvert, spend a significant period of my time talking to industry, talking to regulators and other interested parties about the advantages of data and analytics in the insurance space. And before I get into the study I talked about, I wanted to give an example of the ways in which data and analytics are benefiting consumers as we sit here today. And that is by talking about the process in life insurance called accelerated underwriting. For those that don't know, accelerated underwriting is a process whereby, as compared to traditional underwriting, consumers can get their life insurance faster and easier and less invasively than they can with traditional underwriting. Traditional life insurance underwriting typically takes about 45 to 60 days. It can be very invasive, including being literally painful as you get stuck with a needle to draw blood. And by using data and analytics with accelerated underwriting, it's possible for life insurance carriers to offer accelerated underwriting to their customers so they can get these policies in as little as a few minutes and without those invasive requirements. The result of which has been that consumers are more likely to engage in buying life insurance where they might not have before, and that they are less likely to drop out of that long, more invasive process, meaning they're getting the insurance coverage they need because of the availability of these tools. And so what I was going to talk about today is how we can combine both medical and non-medical data together to help with that accelerated underwriting process, and it'll help consumers get their insurance quickly, more easily, and more accurately than before. I am going to skip through some slides for time reasons. I did want to start off by saying in our study what I mean by medical data are things like vitals, that's things like your blood pressure, clinical lab results, things like your A1C, cholesterol, issues like that, medical diagnoses, so that's, anything from lung cancer to whatever other impairment a person may have, as well as social factors such as tobacco history and tobacco use. As we can see by the numbers on the left, all of these types of factors can be highly useful in evaluating a person's expected mortality, obviously very important in life insurance underwriting. Equally, when I talk about non-medical data, I'm talking about things like a person's MVR driving history. For example, does a person have a DUI violation on their driving history? Things like public record attributes such as bankruptcies or felony convictions, I want to be clear, it's convictions, or credit-based insurance attributes, things that show a increased chance of life insurance, like paying credit card bills on time, or things that have show a negative relationship to mortality, such as being in collections. So much like with the medical data, a variety of these elements are very, very useful in providing estimates of mortality for life insurance underwriting. And I'm going to skip past this for time reasons, but in the medical paper that we have released, one of the things we talk about a wide variety of medical impairments and how combining non-medical data to those medical impairments can help provide a more accurate assessment of a person's overall life mortality risk, and helping to make some of the accelerated underwriting I talked about, the ability to get your life insurance policy easily and more quickly, more available than medical data alone. We cover a number of different types of impairments in our paper, but for purposes of today, I'm only going to focus, in deference to time, I'm only going to focus on one, and that is asthma. Asthma is a condition which obviously isn't related to an incredibly high level of mortality, but it's just enough that many carriers might not be willing to put a person through an accelerated underwriting program if they have it. It has, for example, a 114% SMR. SMR is a traditional life actuarial technique to measure mortality, and it's basically saying a person is 100% means a baseline. Given your age and gender, you're just as likely you're as likely to die as the average person, given your age and gender, with everything we know about you. 114 is slightly above that, and so not all carriers do this. They have different policies, but some carriers, for example, might say, well, anything above 100% I wouldn't accelerate because I want to look at it more. And so with something like asthma, what we can see is that since it's over 100%, many carriers may not be willing to accelerate people on the basis of that particular impairment. However, what this chart is showing is that if we take individuals with asthma and we divide them into 10 equal groups based on the non-medical data, with the far left of the chart being the individuals who have sort of the highest risk non-medical data, the far right of the chart that I'm showing above being the individuals that have the least risky non-medical data, we actually see that there's a great deal of additional predictive value from a mortality perspective by combining these two data assets together. On the far left side, an asthma user that also, a person that has asthma that also has highly risky non-medical data, that mortality jumps from 114% all the way up to 220%, nearly double. On the right-hand side, a person that has a very low risk from a non-medical data perspective, the mortality drops from 114% down to 67%, nearly half. And more importantly, if you think about it in terms of what this really means to an individual consumer, is that maybe all these individuals wouldn't have been able to go through that accelerated program that I talked about with all the advantages. You get it faster, you get it more easily, just by the fact that they have asthma. But what we see by combining the two data assets together is that six of these deciles are really 100% and below. So as many as 60% of these individual cases, individuals with asthma, actually have lower expected mortality than the asthma data, the medical data alone would indicate, and they could all qualify for an accelerated program if the cutoff was an expectation of having 100% expected mortality. So this is a way of combining medical data with non-medical data together to make it so that additional consumers can get can get a life insurance policy more quickly and more easily than they could under a traditional underwriting process. And of course, we have much more extensive studies, behind this. I'm going quickly for time purposes. And so the basic message there is that while about combining medical and non-medical data is the two types of data do capture risk of mortality that is useful to a carrier, that's useful to life insurance underwriting, and that can help consumers get these policies faster and more easily. The interesting thing about the data is they do measure risk differently. So medical data and non-medical data captures different types of risk, and neither set and the two data sets together capture an overall mortality risk profile of a person better than either data set alone. So it's important that they work in conjunction with each other rather than just using one or another. And so the last slides I have here I just wanted to talk about what is the impact, the consumer benefits, the impact to consumers of the utilization of these types of data analytics in the life insurance underwriting space. It's a very common topic in today's environment to talk, for example, about how well do these tools, what kind of impact do these tools have in helping to reach historically underserved communities. I've already talked about some of the more obvious cases of accelerated underwriting. You can get your life insurance policy quicker in a few minutes rather than 45 to 60 days. You can get it less invasively rather than having to have a blood draw. You get it without having to go through that. But there's also a lot of benefits to it that are less obvious than that. For example, it's always been a goal of carriers utilizing these types of tools to help reach that middle market they've been having trouble reaching, to help reach some of the type of people they've had trouble reaching before when agents might, for example, be selling to people lives themselves. And so we at LexisNexis Risk Solutions have done an analysis to see what impact are these tools having on helping reach historically underserved communities that life insurance has had historically had a more difficult time reaching. And I'll give you the answer now, but then I'll walk through what it is. What we find with these tools is that life insurance carriers who use these types of tools reach historically underserved communities at both greater numbers and greater rates than prior to the use of these types of tools. So these types of tools, by making life insurance more accessible, by making it so that all types of consumers are more willing and able to go through the process of buying life insurance, they provide that access to more consumers, and we're seeing an increase in outreach to historically underserved communities as a result of these tools. This is one analysis. We've done others of the effects of that. What this analysis is showing is, according to a standard called BISG, dividing a group of individuals by race and ethnicity, what has been the growth by race and ethnicity of well-scoring applications compared to a baseline year of 2019 in 2020, 2021, 2022, and 2023 compared to a baseline year of 2019 for carriers that are utilizing these types of tools. And what we see is that there are dramatic increases, especially among historically underserved communities, for the use of these types of tools. For example, in 2020, we saw there was a 165% increase in individuals classified as Black by BISG, compared to 2019, 135% for Hispanic. In 2021, 254% for those classified as Black and 255% for those classified as Hispanic. In 2022, 359 and 334. In 2023, 403 and 379. So what we're seeing is that these types of tools, by making insurance more accessible, by making them less intimidating to buy, consumers who may not have wanted to go through that traditional underwriting process with all the, delay and invasiveness it had, and not dropping out of the process because it is difficult. It has had an outreach to all types of consumers, and in particular, it is benefits for historically underserved communities, as seen by our analysis of carriers who are utilizing these types of tools. And if you think about this on an individual level, what does this mean to individuals? What does this mean to real people as they use this? As I talk to agents in the field, for example, they tell stories of individuals who may not have generational wealth, may be from historically underserved communities, who, because of these types of tools, found life insurance more accessible to buy. It wasn't as hard for them to do it, so they went ahead and bought that life insurance. And then when a tragedy did occur, that life insurance was there for them despite the fact that they didn't have that generational wealth. And it allowed their children to build better lives for themselves as the parent would have wanted. And it allowed them to go out and pursue, the kind of dreams that the parent might have had for their children, despite not being able to pass along generational wealth, when a tragedy did occur. And especially if you think about it as compared to the flip side of the coin, if that life insurance had been there, there's obviously an immense amount of difficulty when something like a parent passes away and all the adversity that brings aboard. So being able to access this life insurance, being able to utilize these types of tools to make it more accessible to all types of consumers has really had an impact on individual people's lives as they go about trying to make a better life, better make a life for their children and making sure that they're insured against, against tragedies occurring. So that was my, hopefully, relatively quick overview. I know that that's a fairly dense amount of material in a fairly quick amount of time, so I'd be happy to take any questions either now or after the session for anyone that might have some.
Thank you, Mr. Patrick. I do have a question.
Sure.
How long do they look at those factors, and how many time does it take to factor it in?
To take a look at the medical and non-medical factors?
So let me give you an example.
Yes.
If a 50-year-old had a credit problem when they were 25 or 30,
7 years.
okay, or a 30-year-old DUI compared to, if it had happened 2 years ago?
Yes, so typically, it can vary depending on the type of data source. For example, there are some medical conditions that if you have them, even if they were diagnosed early on, they're still part of your current condition. But generally speaking, for the non-medical data, you're talking about a look at of up to 7 years, with more recent data being more important to the equation. I also should probably mention, since you were throwing out different ages, that it is very much the look back is age and gender normalized, meaning you're being compared to other people of your same age and gender group, not to people that have had, for example, more opportunity to build up, certain types of characteristics than others.
Okay, all right. Anyone having questions? All right, thank you,
Thank you very much.
Patrick. Next on our agenda is consideration of proposed amendments to the NCORE Life Science Model Act. We've been discussing this issue since our spring meeting in Nashville, and now it appears that the amendments are ready to be considered. Before we go any further, I'll turn things over to the sponsor of the amendments, Oklahoma Representative Forrest Bennett.
Thank you, Mr. Chairman. I appreciate the recognition. So I am presenting these amendments, so thrilled to do it. The model that we're looking at is being reauthorized and just needed some technical updates. You can find the amendments in your binders on 160, 165, and 170. They started out as two categories. One was modernizing the model, and the other focused on whether agents should be able to be or should be prohibited from disclosing the option of a life settlement when a client comes to them thinking about dropping their policy. And in the spirit of compromise on the first issue, both sides agreed to the first category, and in the spirit of cutting my losses, I agreed to withdraw the second. But I want to walk through what we do end up having. So on page 160 is an update that includes an original or facsimile. This is a word, Pat, facsimile is a fax, and a fax is a copy of a document that's sent electronically. And on 165, with respect to an insurer, they can't deny the legal effect of something solely because it is an e-signature. Tom, an e-signature is just like a regular signature. So, and then on 170, it just clarifies that nothing can be denied simply because it's an e-signature. So I really do appreciate that both sides worked well together on these compromises to get something done. And as a sponsor of the legislation, I really did not see the the issue with an agent being able to disclose the ability to have a life settlement option, but I don't want to tank the whole thing because it's not perfect in my view. So I'm endorsing these updates, and I want to encourage my colleagues to think about taking on the other aspect of this when they take this model legislation back to their legislatures. But again, I want to move forward today with the amendments I described, and I encourage my colleagues to support them. Thank you. Back to you, Mr. Chairman.
Thank you, Representative. I understand that you had pretzel and ice cream.
I had neither, and that is libel. I'll be faxing you a concerned letter.
My fax machine doesn't work. We don't do that anymore. All right, thank you very kindly, Representative. And now we have Mr. Nat and Jill is here, right? So we're going to allow them a few minutes to talk to us.
Mr. Chairman, always a pleasure. Thank you, sir. And thank you to Representative Bennett for his work on this and for his presentation, which pretty much covers the waterfront, I think. Just briefly, the model was up for reauthorization. Life Insurance Settlement Association members were polled and provided some suggested changes. Those have been published and discussed. Representative Bennett explained the compromises that were made, and it was a pleasure working with ACLI and Jill and the other staff there, and I think that discretion, better part of valor, or whatever the proper phrase is, we decided to try to avoid. I think there's still blood on the walls from the last time around, and we wanted to make sure that got cleaned up rather than expanded. So we were able to agree on what we think is Rep. Bennett said is appropriate changes in a world where business methods have evolved. And I was just starting to get used to using my fax machine, and now I see that I'm woefully behind. But those who actually do business will benefit from this, although I'll just be confused.
Thank you, Mr. Chair. Thank you, Representative Bennett. On behalf of ACLI, we do appreciate the extra time that you allowed us to talk about these proposed changes with Lisa and with Alan from Coventry. And ACLI is in support of the compromise that we've come to and thinks it's very reasonable to require acceptance of electronic documents and electronic signatures. So again, thank you, and ACLI is supportive of the changes.
All right, thank you, everyone. Here, no further questions or comments. I'll entertain a motion to adopt the amendments.
Seconded.
All right, it's moved in second. All in favor signify by saying aye. Aye. Those who oppose will stand. The ayes have it, and so is ordered. I know nobody wasn't going to stand because y'all already had pretzel and ice cream and all that stuff. Okay. We'll now entertain a motion to readopt the model as amended.
So moved. Second.
All right, it's properly moved in second that readopt the model that has been amended. All in favor signify by saying aye. Aye. Those who oppose will show sign by raising your hands. All right, the ayes have it, and so it's ordered. Thank you, everyone. The model as amended will now be placed on Sunday's Executive Committee agenda for final ratification. Yes. Next on our agenda, and we got to move very fastly, is an update on the Interstate Insurance Product Regulation Commission activities. With us today is the one and only Ms. Karen, Executive Director of the IIPRC. We'll hold questions until she's finished. Come on, Ms. Karen.
All right, thank you,
It's
Chair
all good.
Anderson.
It's
I appreciate
always
it.
good to see you.
It'll be
and Thank
quick.
you for
Thank you.
joining us as always. Please
Thank
go
you.
ahead.
Well, IIPRC means the Interstate Insurance Product Regulation Commission. And believe it or not, it has been in existence for 20 years when Colorado and Utah enacted it this year. Since then, several of your states have joined this legislation. In fact, South Dakota just joined this year. So I'm actually going to give credit to Senator Klein, who was here earlier, because North Dakota joined in 2023 and South Dakota followed. And I guess that's a thing. So 46 states, the District of Columbia, and Puerto Rico are part of this state-based regulatory legislative partnership. New York, California, Florida, they have yet to join, but we hope South Carolina will rejoin soon. NCOIL, as many of you know, has been a longtime supporter and participant in the compact and its activities. We have our own legislative committee, which NCOIL appoints 4 open seats, as well as NCSL. Indiana Representative Matt Lehman is the chair of that committee. Kentucky Representative Rachel Roberts and Oklahoma Representative Forrest Bennett were appointed last year to that committee. And our newest appointment was Massachusetts Representative David LaBeouf. So they join with Representative Dunnigan, as well as the Representative Kennedy from Rhode Island, Senator Laura Fine from Illinois, and West Virginia Delegate Dean Jeffries. So we have a great, robust legislative committee that met in Denver with our management committee last week. We had a very good interactive conversation. One of the things the compact does, and in fact, we also presented to the legislators at that meeting about the compact. Happy to go into more detail about what this compact is. Many of you are working with compacts right now in the occupational licensing area. This is one of the more innovative ones in terms of insurance products and approval for life insurance, annuities, long-term care, and disability income. These are products that you can buy in your state, take to another state, and claim on it. And they compete with the banking and security. So it really makes sense to come together and promote uniformity. One of the things the compact has done over the past 2 years, since 2022, was hold compact roundtables. In fact, our first was in conjunction with NCOIL in the New York City meeting, and they bring together legislators. Many of you around this table have participated with regulators, commissioners, as well as companies and consumer representatives. And those ideas, we formed a committee to really look at those ideas. And I wanted to just mention that committee. It's called our Adjunct Services Committee. That is a compact that's really promoted a lot of uniformity and has helped states not only to build robust standards, but to make sure your products are approved under those standards. And now they're looking, as your states are tight budgets, dealing with retirements, how can the compact office and the team help states? And so one of the things they're looking at is building a framework to make actually not only the product approval, but before a product even gets to a department, can we help make that process more efficient? Instead of a company like Assured Allies going state by state by state and giving the same presentation, can we help collaborate that? And NCOIL, rightly so, just said, hey, we know you're looking at these adjunct services. We want to make sure that you're keeping in mind the authority that the legislature granted here to the compact and to the regulators. And hopefully you got the assurance that we definitely are. No, there is no plan to go outside the 4 corners of the compact in terms of the products that we're talking about, or that approval beyond those, what we call uniform standards, which are what states adopt. So with that, and then I'm going to just leave you with the compact was really developed in the early 2000s as a response to the optional federal charter. And so for a lot of reasons, you don't hear that as much, but again, the compact has really made it much more easier to go through the state-based system for product approval. But we've preserved your filing fees. So this year, to date, we've collected and remitted $2.4 million to all the states, $36 million over the last history of our compact. So just wanted to leave you with that. Happy to answer any questions or to go into more detail for those of you not familiar with the compact. Thank you.
Thank you, Ms. Karen. Did I just hear you say that, you will bring $2.4 million to South Carolina?
I can get you the number. I will tell you, it's sizable.
Come on to South Carolina. We go back second Tuesday in January, and I'm inviting you to come. I'm inviting you personally, to come to South Carolina. We need to get on board with that. Now, I'm sure, we'll be talking more about that, but thank you.
Yeah, we work very well
informative
with your
today.
department. Thank you.
$2.4 million. Plus
It's
interest.
across all states. Yeah, there you go, plus interest.
Plus interest. Okay. All right. We're good. Do we have any questions? All right. Well, thank y'all for your understanding today. Last on our agenda is an update on the resolution in favor of encouraging a redesign and the use of lifetime income investment solutions and defined contribution plans. You can view this resolution in your binder on page 171. Although it doesn't say anything about faxing,
We can
we've been
change that.
discussing this issue throughout the year, and it appears that we still have some work to do. With us here today is Mr. Josh from TIAA, who will provide a very brief update on their work with us. And Mr. Josh, please tell us who you have along with you.
Thank you, Mr. Chairman. My name is Josh Freely, and I am Regional Vice President for State Government Relations for TIAA. And I have Gerard Neely, who is my colleague also on the State Government Relations team at TIAA. We are here to discuss the resolution. It is in your 30-day materials, and we plan to bring it before the committee in April. We think that this resolution really addresses a looming issue for our future retirees. As the population ages and 10,000 people a day retire, the United States really stands on the precipice of an economic and financial crisis. There is a significant gap between the amount of money that people need in their retirement and the amount they are saving. At this moment, that gap stands at about $4 trillion. If current trends continue, this gap will cost state budgets about $330 billion in additional spending by 2040, and $1.3 trillion in state and federal spending combined. But those numbers don't really tell the whole story. People are increasingly expressing anxiety over the state of their retirement savings. In a recent public opinion survey, over 40% of respondents said that their savings were not going to be, they were not saving enough money to meet their retirement needs. Moreover, over half of Americans over the age of 65 live on less than $30,000 a year, and 20% of those live on less than $15,000 a year. And the problem is actually particularly acute for public sector workers. In a recent survey of government workers, only 9% of those workers said that their retirement benefits that they are provided through their employer are sufficient to meet their retirement needs. Now, my colleague Gerard is going to talk about some of the solutions and how we think this resolution is really a start at addressing some of these issues.
Thanks for that, Josh. And as Josh was mentioning, we're really hearing from workers, according to recent survey data, about 70% of participants in this survey would choose to stay or work at a company that offers a guaranteed lifetime income stream in their retirement. And we're also finding that around 75% of workers would prefer lifetime income stability over, principal preservation in their retirement years. So we're really starting to see that everyday American workers are realizing themselves not only the retirement savings issue, but also the lifetime income issue. So with that said, the lifetime income resolution that we have included in your 30-day packet, we think is really a great first step at continuing and taking a further dive into this issue. Firstly, this resolution will call for legislators to understand how much, if any, lifetime income their respective state retirement plans provide to their employees. Secondly, we believe it is important that legislators examine and quantify the current amount of lifetime income for employers also in the private sector. And finally, and thirdly, legislators should enact policies which encourage education for retirement plan participants on their investment options and how to best achieve their retirement goals.
We would be happy to take any questions, and I would just like it noted that we were very quick in order to get you all out to the party, and so think about that when we come before you in April. So, but
Thank you, Mr. J and J, Mr. Josh and Mr. Gerard. I tell you what, y'all have been on it today. Man. Thank you very much. We will continue to work with you. TIAA, and we look forward to next year. And while we're on that, I got a commercial that I'm going to say to y'all. Tell everybody, all legislators, all members of NCAL, all of you that's out there, consultants, lobbyists, whoever you are, do not miss NCAL's spring meeting in April 2025. You're coming to Charleston, South Carolina, and I'm inviting all of you. We're going to show you how things are done in South Carolina. You will not be displeased at all. We're going to dance inside the hotel and on the streets. We're going to just show you a good time in Charleston, South Carolina. So we look forward to all of you coming. Those of you who are working on your job, please put in, be real nice from here until, your boss man or whoever gives you the permission that you can come to Charleston. Don't tell them why now, but we're going to show y'all a good time in Charleston, South Carolina. Spring meeting, April 2025. Commercial break over. All right, any other questions, comment from any of the members? And thank all of you for being here today. It is 4:48 p.m. To those persons that are on the nominating committee, our meeting is immediately following this meeting downstairs, lobby level in the EI Racon room. Please go there as quickly as possible. And don't forget, at 6 p.m. this evening, everyone is invited to Tom's reception. We will be honoring him at 6 p.m. Thank you again, and we look forward to seeing you later today.